Good morning. Gosh, it's nice to get a response. There are people alive out there. Thank you. I have to say, being invited onto stage like that is quite dramatic. Normally we just stand here, so that's quite impressive to start with. Welcome to everybody. We are delighted to see you here. I think I can see you well enough to know. Can I just ask for a quick show of hands, please? How many people here are attending our forum for the first time? Oh, that's fantastic. Well, we're delighted to see you here, and welcome, obviously, to those who are coming for the second or subsequent times. It's great to see you all. I will repeat this later on before we do the Q&A session towards the end, but can I just remind you all that we are unable, I'm afraid, to answer any personal questions you have about your own individual pension today. However, we do have desks for both LPFA, our administrators, and the charity tax aid in the forum, and they will be very happy to pick up on any personal or tax-related queries that you may have. This is really a very important event for us. Meeting you all face-to-face is a really valuable opportunity for our team, and I also hope that all of you will leave today with a better understanding of how we're run and how we invest. But if there's one message I'd like you all to take away from today, it is that your pensions are safe and the fund is in good shape. If you take nothing else away, please take that away. By the way, the image that was up there, no, this image, that image is of the Edge. I'll talk a little bit more about that in a minute, but that's a significant net zero development in London that we're investing in, and I'll say a little bit more about that, as I say, later on. Let me just start with very briefly going through the agenda. You have a session from me. Then we're going to turn over to Richard Tomlinson, who's the Chief Investment Officer of LPPI, who are our investment advisors and managers, and he's going to be talking about how we invest and what we invest in. We'll then hear from Joe Derbyshire, the Managing Director of LPPA, who are our administrators, who are the people who are actually responsible for making sure you do get your pensions. Then we'll break for coffee. After coffee, you'll hear from Paul Hewitt, who's our responsible investment manager, who will be talking about the way in which we try and invest responsibly and think about some of the environmental, social and governance issues that I know from our member surveys concern all of you. And then we're going to have 30 minutes of Q&A where we're going to have a mixture of questions from the audience and a number of questions from people online. We've already had some good questions, but we will try and get a good mix of questions from the audience and online. We've got about 300 people in total between the people in this audience and the people online, so that's a really good attendance for an event like this, and we're really grateful to all of you for coming. Excuse me. I want to summarise our progress this year, but that probably means I have to start by setting out our 5 strategic objectives, which our board uses to measure how we're doing. I mean, obviously, or at least I hope it's obvious, our single most important purpose is to make sure that we pay you your pensions as they're due and to which you are entitled and for which you've worked all your lives. In order to do that, we've got to generate income from our investments over the long term, and we also have to manage the risks that we face both to our investments and in managing the fund. As a board, we're committed to continuously improving the way in which we're run or governed, and in trying to be transparent in what we do. And we do believe very strongly in the power of collaboration and making sure that working with others and learning from others and sharing what we know is something that we can bring to the party. But before I do that, it probably is important that I just go back a little bit in time to show you just how far we've come. So in 2014-15, 10 years ago, we had about 80,000 members, and the assets of our fund were valued at about £4.9 billion. Today, if we roll forward, we have almost exactly 100,000 members. It's about 99,900 and something, and our assets are just over £8 billion. We're the largest LGPS fund in London by quite some way, and we're in the top 15 LGPS funds in the country. And I hope that helps to give some sort of context to when I say we're a secure fund and your pensions are safe. You can see that there is a substantial amount of money backing everything that we do. So let me move on and look at each of our 5 strategic objectives in a bit more detail and see how we've managed against those over the course of the last 12 months. As I say, the single most important thing we do is make sure that we pay your pensions. In order to do that, we collect every year about £102 million from the employers in the fund, and we collect nearly £50 million from the employees. To that, we add all the income we earn on our assets and investments, and we pay out in pensions about £264 million a year. That's about £22 million a month to our retired members. And I hope that gives you a sense of just the scale of what it is that we're managing here, and also the amount of effort and energy that goes into managing the fund by our administrators, LPFA. And I'm really pleased that Joe Derbyshire, the Managing Director of LPFA, is going to be here to talk about the work that they're doing a little later this morning. The second of our objectives is to sustainably manage the fund and manage the risks. And it's obviously hugely important that our investments perform well and that we do manage the risks that might lessen the value of our assets or the effectiveness of our organisation in managing those risks. In terms of investments, our performance has been amongst the best in the LGPS over the last 3 or 5 years. Over the last 12 months, the relative performance hasn't been quite as good, but in absolute terms, i.e. the absolute amount of money we've made, we've been very happy. And over, as I say, the 3 and 5 years, our absolute and relative performance has been amongst the best in the LGPS. And that performance really is a testament to the work that LPPI, our investment advisors and managers, have done, and the way in which they invest the assets of our fund. And I'm delighted that Richard Tomlinson will be here later today to give us some more insights into the work that LPPI do on our behalf. But we also have to manage and take great care over managing the risks that our organisation faces. This year, we've invested in improving the size of our staff in both legal, regulatory and compliance, and we spent a lot of time investing in our technology to assist us in managing those risks. We've also, I think, made real progress in managing the environmental, social and governance, the so-called ESG risks that we face in looking after our investments. And I'll say more about the whole subject of responsible investment in a few minutes. For those of you that are new to this event, this chart basically shows how the pension fund is managed or governed, as we call it. We have a board of 11 individuals, the majority of whom are pension or investment professionals, independent, and the rest are local government representatives. And the board oversees the work of 25 staff members, and we have 2 committees of the board which help us look at some of the issues in more detail than as a board we do. That's the Audit and Risk Committee and the Investment Committee, and they do very much what their name says on the tin. We own 50%, together with Lancashire County Council, who own the other 50%, of LPPI, our investment managers and our investment managers, and 50% of LPPA, our administrators. And LPPI manages the investments. They give us advice, and they actually implement those advice for us. LPPA is our administrator, and they manage your details, and they make sure that you do get the pensions from us as we go forward. We also get reports and advice from the local pensions board, which is made up of representatives both from you, the membership, and from our employers. And that's how we try and make sure that we stay in touch with how our key stakeholders are feeling about what's going on. If you're interested or more interested in how the fund is run, please go to our website where you can see the detail, particularly our annual report, which I'm delighted to say we published last Friday. The third strategic objective is to invest responsibly and for the long term. And Paul Hewitt, our responsible investment manager, is going to cover this in more detail after the break. But I did just want to mention it, particularly since this is a relatively hot topic at the moment, as partly because there's been a bit of a backlash almost against responsible investing in some parts of the world, particularly in some parts of the United States. Now, of course, we realise as a board that we live in an interconnected world and that what we do and the way in which we invest affects everyone. But I want to be clear, we don't invest responsibly because we are woke or because we have a moral or ethical stance. We believe that investing responsibly is vital because if we don't invest that way, then over the long term, and we are a very long-term investor, that will affect the value of the assets that we have and therefore affect our ability to pay your pensions. So, we do take this very, very seriously. And as an example, earlier this year, we published an updated responsible investment policy, which sets out the main areas of risk to the fund and how we're attempting to deal with them. And we do know that from our last member survey that this is an issue that concerns our members. So I would encourage you to go to our website if you're interested and have a look at our responsible investment policy. Many of you will also be familiar with our Net Zero Hub, where you can track our progress about meeting our climate change objectives. And we're looking to expand that in the coming year. We're going to be working to try and turn the Net Zero Hub into a responsible investment hub, where you can see in more detail everything that we're doing to try to invest responsibly, including things like equal pay and things like that. And that sort of area is a really good example of the next area of strategic objective for us, which is to try and encapsulate our commitment to being as transparent as we can. We do think that transparency is fundamental in showing you and our other stakeholders what we're doing, and it helps us demonstrate, I hope, that when we say we're doing something, it's not just lip service, we are actually trying genuinely to make a difference and do things. And communicating with all of you and others regularly is part of that commitment. We host events like this. We host a similar event for our employers, which we imaginatively call the Employers Forum, and we share information with you face-to-face where we can, like this. We also share information on digital channels as well. We talk to the press, we share information through our website, and hopefully directly to you via our newsletters. We publish the results of our members' survey, and we also publish the results of our climate change progress, and there's other information on our website that you can look at and see, hopefully, how we're doing. It's worth mentioning that in previous member surveys, you've asked us for more information on how we invest. In response to that, in 2022, we launched our equities dashboard, where you can see the companies that we're actually investing in. And this year, we launched our Investing in the UK map, which shows the infrastructure assets, the wind farms, the business parks, the ports, and things like that, that we actually invest in. And taking those two things together, you can now see roughly how 70% of the £8 billion fund that I was talking about earlier is actually invested. And the final strategic objective is collaboration. And it really is key to everything we're trying to do. We believe that working together with others will help us run the fund better. We speak at an awful lot of events and conferences to make sure that our voice is heard and that we hear the voices of others. We're members of many high-profile forums in the pensions industry, and we share our work with the media and social channels. But for this slide, I really want to focus on one area which I know from member surveys appeals to many of you, and that's the London Fund. You might remember on the right the picture of the Edge, and I'll say a little bit more about that in a second. But the London Fund was a joint venture that we set up together with our pool managers, LPFA, and the other pool in London, the London Collective Investment Vehicle. And between us, we've raised £250 million. We put in 150 million, and the boroughs of Haringey, Sutton, and Kingston and Chelsea invested another 100 million between them. That 250 million is being invested in projects which do two things. They meet the required investment return. We don't invest for charity. We invest because we're getting an appropriate return. But if we can also find investments which benefit London or benefit the citizens of London, then of course we will try and do that if we possibly can. So there's just a few examples here of some of the things we're investing in. On the top left, we have the Savile Theatre, which we're helping redevelop, and which we're hoping will be the London home of Cirque du Soleil. On the right, we've got the Edge, the building I referred to earlier, and that is going to be one of the greenest office buildings in London, for which we're getting an appropriate level of rent. On the bottom left is Shepherd's Bush Market, which is a regeneration project, which also includes some affordable housing in the mix. And the final one is DOOR, D-O-O-R, which is a development project which aims to provide over 12,000 homes for Londoners in places like Stratford and the East Village. All of these are examples of how the London Fund is not just getting the appropriate level of return, but is hopefully helping to assist the people of London. So, in summary here, I hope you're taking away from what I'm saying that our investment performance is good and we're in robust financial health. I believe we're well governed, and as I hope we've shown, we're meeting our strategic objectives. We will continue to strive to improve the service that you get from us. I think we've made real progress on this year. We recognised that last year there had been some challenges with the service because our administrators, LPFA, were going through a process of putting in place a new administration system. They were forced to do that because of actions outside of their control in 12 months rather than the planned 24 months. And that did lead to some hiccups, but they've made huge progress this year. And I think you'll be really pleased when you hear from Joe later on about just how well they've managed that. We've got a good team in place at the LPFA, and we are preparing for the evolution of the LGPS, and I'll say a little bit more about that in just a second. There is always more we can do, of course, and we do genuinely welcome your feedback on areas that you'd like to hear about in the future. By way of example, we are going to be publishing our next member survey in 2025, so I would encourage you, please, to look at it. We do really value what you do, and I hope from some of the things I've said earlier, we do listen to what you say and try and make sure that we can meet your requests. So let me just finish by saying a little bit about the future. Many of you will have seen recent headlines about how the government is looking to reform the LGPS, the Local Government Pension Scheme. And as I'm sure most of you appreciate, the LPFA is an individual fund, but it operates one of the Local Government Pension Scheme rules. So there is a single set of rules for the LGPS, which applies across England and Wales, and we are one of 86 administering funds for that scheme. You might really ask the question as to why there are 86 of us. I couldn't possibly comment, other than to say that 33 of them are in London. But the crucial point I want to make is that you may have seen an awful lot of press headlines about this. You may have heard an awful lot of press speculation. None of that is going to cause any challenges to the LPFA, to your pensions, or to the way in which we run our fund. Indeed, the proposals are all about, or primarily about, two things. Let me start again. Sounds like a Monty Python sketch. It's about three things. The first one is they are really interested in the way in which the investment pools operate, and I'll say a bit about that in a second. They're interested in trying to improve governance of the way in which the LGPS is run, and they're interested in trying to encourage local investment in the broadest sense, whether that's London, whether it's the UK, or so forth. But if I start with the first of those, pooling, without boring you to death, there are 8 investment pools within the LGPS, and all the 86 funds I talked about are members of one of those pools. Our pool, LPPI Investment, when that was created back in 2015, we actually did it before pooling became mandatory. And when it was set up, I claim no credit for this because I wasn't chair of the fund at the time, but when it was set up because a lot of work was done to look around the world to try and identify the best investment structures for running big funds. And on the back of that, we adapted those structures for us and came up with a structure that we believe works. I'm very encouraged to say that the government clearly seems also to think that it works, because the mandate they've put out for all the other funds to follow is pretty much the model that we've got for LPPI. So this is not me saying that we're the best, I'm just saying that a lot of thought went into that model 10 years ago, and the government, having done the same research we did, has come to broadly the same conclusion we did. So in terms of the impact that it makes on us, very, very little will change. You may see that some of the other pools start to think about whether they want to merge with others or each other and so forth, but none of that will affect any of your pensions. Similarly, one of the things that the government is keen on is to try and see if they can improve the governance of the LGPS, which are run throughout the country by local authorities, by elected councillors and so forth. And I mean absolutely no disrespect or criticism at all, but of course a number of local councillors will know before they sit on the pensions committee very little about pensions. And the government is trying to make sure that when they sit on pensions committees, they have to receive proper training, that they have to have appropriate officers within the council to support them. So I'm not in any way criticising, I'm just saying I think that these minimum standards of governance are a good thing. But I mentioned earlier that we're governed by an independent board, so our governance standards are already way past the minimum standards that the government is proposing. So again, there will be no impact on us of any significance from these challenges. And finally, they're really keen on encouraging investment in the UK. Now, there's a couple of points I want to make here. I was talking to a gentleman before we came in here, and he made the perfectly understandable point, could we please make sure that the government keeps their hands off our pensions, please? Yes, I agree with that. It is not the business of government to start telling us how to invest our assets. And if they were to start saying, you have to invest in this particular investment, or even if they were to start saying, you have to invest a certain amount in, let's say, UK equities, that starts to become quite difficult, not least because I've been doing this for 35 years, I have absolutely no idea what a UK equity is. I mean, is BP a UK equity? Well, it's about as British a company as you can get, and it's listed on the UK Stock Exchange, but about 90% of its assets and its income come from outside the UK. So is that a British company? I've genuinely no idea. Where it starts to make more sense is when you start talking about things like infrastructure, roads, ports, railways, wind farms, solar power, things like that. And when you're starting to talk about real estate, affordable housing, social housing, net zero buildings, all of that sort of stuff, there it makes more sense to be talking about the UK and investing in the UK, because actually that's where you can have the best control, you've got the best sight of what you're doing, and where there is a desperate need. And as I think we've shown with the London Fund, if you've got a fund which can both achieve the desired financial return and make the difference for people in London or the boroughs of London or across the UK, then surely that has to be a good thing. And by way of information, roughly 13% of our assets are invested in UK infrastructure and real estate. So, you know, the government has said, well, maybe funds should have 5%. We're already way past that, and we're getting a good return on all of those investments. So all of the headlines you've seen, there are some interesting things to pension geeks like me, but as far as all of you are concerned, please be assured that nothing here is going to significantly affect the way in which we're run, or more crucially, the security or safety of your pensions. So with that, I will draw it to a close. We have opportunities for questions and answers later on in the session, so if anybody does have any questions on what I've said, I'll obviously be very happy to take them there. I'll also be around in coffee break and at lunch if anybody would like to chat, and please do. Notwithstanding I'm wearing this weird headset, I promise you that when I'm off this stage, I'm not broadcasting everything that we're saying. We will, of course, be recording it and blackmailing you afterwards, but that's a completely different point. Can I, with that, thank you for your attention. It's really good to see you once again, and I'd like to welcome Richard Tomlinson, the Chief Investment Officer of LPPI, to the stage.
Good morning. So I won't introduce myself as John has very kindly done that, so I'll jump straight over to the opening slide. So a little bit on LPPI. Who are we? Many of you have probably been here before, so I'll keep this brief. I won't recount many things, repeat the points too often, but just a quick intro. We manage the portfolio for your pension. So of the assets the LPFA has in the pension scheme, all of them are delegate. We manage that whole portfolio on behalf of the LPFA to enable the payment of your pensions as they fall due. There are two elements to that. The first piece is we give the LPFA investment advice on how to think about the overall framing and the asset allocation, where the assets are invested on a sort of asset class basis to optimally meet that long-dated liability profile. Again, so when those of you that are in retirement or those of you that are working towards retirement, that there is sufficient capital there to pay your pensions as they fall due. The second part of what we do, the other key pillar, is we then manage the assets within that portfolio. So it's advice and management. So on the management side, we take the whole portfolio and we've pooled it with assets from other LGPS schemes. So we manage money for 3 clients, so Lancashire County Pension Fund and Royal Berkshire Pension Fund, County Pension Fund, and they're integrated into pools and they're all managed on a scaled basis, as the government asked us to do around about a decade ago. And as John touched on earlier, the government is now evolving their thinking on what they would like to see from pooling. How do we invest? Ultimately, the goal is to pay all pensions as they fall due efficiently and affordably. So we take that capital in and we invest it, and we're looking always to say, how do we invest in the appropriate way, in line with the beliefs of the fund, so the LPFA, and in line with the beliefs we have put in place and our values, to then invest, to drive the capital to pay pensions they fall due. And there's 2 elements to that. There's grow the capital and have income for paying pensions that you need to pay today. Clearly, we look to invest responsibly, and I'd say we take the ESG and responsible investment very seriously, and we look to invest in an efficient, thoughtful way that's very process-driven. And we work very collaboratively with the LPFA to ensure we execute the strategy as they want it, as they would like it. So a year in review. Been quite a busy year. I was here around 12 months ago, probably almost very close to exactly 12 months ago. 2 things stand out this year. Interest rates and inflation have been 2 key themes falling that have come down over the year. I think if you look back to last year, there was a lot more concern, or anxiety may be the right word, around interest rates and inflation. Both were seemingly marching up, we're on a continuous march upwards. Both are moderating this year for various reasons. We've seen them come down, and that has had an impact on the portfolio, and that's on a global basis, not just the UK. But I think we do need to be mildly cautious. I think that to temper that a little bit, that in my personal view, I don't see interest rates coming right back down to where they've been in the last, say, decade or 2, with very, very low levels. I think they are going to remain a little bit higher. And the same with inflation. I think inflation is more likely to have a bit more to the upside than the downside going forward. I think the key thing that many of you will be aware of, though, I think I'll get this stat right, I think it's half the world's population has gone to the polls or to vote this year. Nations with half the world's population are voting this year in terms of electing new governments. And that's a very meaningful thing. We've obviously had an election in the UK, which has had some domestic impact, but on a global basis, frankly, it doesn't make that much difference. But in the US, there has been an election, as I'm sure you're aware, and I think that is going to be of global significance in terms of where the US may be heading from where it's been. And that cuts across multiple dimensions, whether that's investment in the green transition, or energy transition, I should say, through to geopolitics, interest rates, inflation. So the US election is a very meaningful event, and as I say, it's probably beyond the scope of this conversation to go into all the detail of that, but to summarise, it is a key event, but we have had a clear outcome. And I think at times I've wondered about the state of democracy in the world. However, the United States have clearly delivered a verdict on what they are looking for in terms of the election of President Trump. So that's a clear signal from the US. In terms of how we think about building the portfolio that we've built, or the LPFA has, that backs your pensions, is very diversified. It is a global portfolio, and I'll touch in a little bit more detail in a moment what that means. We've got some investment performance continues to be positive, and I'll have a little bit more detail in a second. And cost savings, continue to roll in. We've saved now over £100 million of fees since the inception of pooling. And that was for those of you that are familiar with the government's pooling agenda from 10 years ago, that was one of the key pillars that the government asked of LGPS pools was cost savings. The others also align very well with what John said earlier, which was improvements in governance, building of scale, and investment in UK infrastructure. So the total fund value is now £8 billion. As you can see, it's increased dramatically since 2016. Always great as an investment manager or a CIO to see a chart like this going bottom left to top right, broadly increasing. But we can say that the fund is going to continue to compound and build capital to pay pensions in the future and meet the liability profile that the fund has. So in terms of the asset allocation and the investment strategy, this gives you this little, what do you call that? It's not quite a pie diagram. This ring gives you an indication of how the fund is invested. So approximately half the portfolio is in global equities. That means stocks and shares, listed stocks and shares. I think I heard John mentioning BP earlier. That means listed companies, some of which you'll be familiar with, whether it's Google, Alphabet as they're called now, Microsoft and other names of that nature. So half the portfolio is in listed equities on a global basis. So it's a broadly global portfolio. But the other half is in the everything else. So at the top, we've got a little bit of fixed income and cash. Fixed income means bonds, so some of you may be familiar with that sort of interest-bearing instrument. That's really sort of liquidity in the portfolio, cash to make payments and to fund the working capital of the portfolio. But as we work around the portfolio, I'll go counterclockwise. So we have infrastructure, around about 14% is in infrastructure. And that means, in high level, direct infrastructure, private infrastructure. So that means owning, I think John mentioned, ports, that means roads, airports, that type of thing, trains. So it's investing directly in that, and the bulk of that portfolio is focused in the UK, and the bulk of that is directly managed by LPPI, our team. So we're looking to invest directly, drive impact into the UK, or drive alignment with the UK, and do it in a cost-efficient way by doing it internally. 15% of the portfolio is in credit, which means essentially lending. The bulk of that is probably what you call corporate lending to companies to grow their enterprises. But there are other things in there. There's some real estate debt, so lending against property and other things like that. But around about 15% is what we call credit lending type portfolio. It's just over 11% in real estate. What does that mean? That's broadly, the bulk of that is commercial real estate. So that means offices, that means sheds, essentially logistics hubs. That means there's a few hotels in there, things of that nature, but broadly commercial properties where we own the building and the land, and then generally it's leased to others to operate the business within it. There is an element in there of other things, such as housing. So for those of you that have been to this event multiple times, you'll know that we've invested over the years in affordable housing and similar. So there is a degree of residential property in there, albeit what you might call wholesale residential properties. These are large blocks, these aren't single houses. Final 5% would be private equity, and of that, that's privately owned businesses. That's investing in privately owned enterprises, providing them with growth capital to grow and develop their businesses. So a little bit on UK investments. I don't know if John mentioned percentages earlier, but for LPPI and for LPFA, approximately 20% of the portfolio is in the UK. The bulk of that is in private markets. There is a degree of investment in UK listed equities, but the bulk of it's in private markets. And of that, the bulk of it's infrastructure and real estate. So it's where, when you look at these assets, you can see that they are driving impact and societal outcomes more directly. So it's owning, the examples we've got here, Hornsey 1, it's a very large, I'm not going to say it's the largest wind farm, I think it's the second largest wind farm in the UK now, but it's a very large wind farm that we own a part share of, and we own other wind assets. But we have various assets in the portfolio that are contributing to the green transition, supporting not only the green transition, but also energy security for the UK, which has now become a more critical element. So it's investing in supporting UK as a whole and broader benefits for the UK. And the asset on the right, which is one that I love. I've got some of my colleagues are in the room. I can't see them because I'm getting dazzled by the lights, but I love this picture. My son was born at UCLH many years ago, about 10, 11 years ago, so I love this image. The fact that we own a chunk of certain assets. We own a chunk of UCLH. Oh, sorry, I should say University College Hospital London in Euston. It's an asset that we own part of and support via that. Investment performance. So there's a few bars on here. So just to put this in context, for the fund to meet its liabilities, very roughly, we need to deliver a return in the range of 6.5%, something like that. I'll call it 5 to 7, something like that in the long run. That's what you would call the discount rate of the scheme. So if we're delivering that return in the long run, it means the fund is keeping up this liability payments. So as you can see here, the returns, the absolute returns, which is the blue, is running at, all the 1, 3 and 5 year horizons, it's 7-point-something%. So it's in that zone. We're generating enough return to stay ahead of the liabilities and generate return to pay pensions in the long run. There are some other comparators on here. We would tend to focus on the 3 and 5 year rather than the shorter term 1 year numbers. And there is, as I said, there's multiple comparisons here against the policy portfolio benchmark and the return objective that we've agreed with the scheme. And they're running on different things. One of the key things here, there are two things to touch upon as to why what's driven those benchmark performance. In the short term, the 1 year number is very, not say skewed, but is uplifted by the very significant outperformance of a handful of equities in the benchmark, amongst others, but the Magnificent Seven, who you may be aware of, Microsoft, Nvidia, and other things. Some of those names which have performed very, very strongly of late. I don't have a crystal ball, so I can't tell you whether they will continue to perform in an incredibly strong way, but that's what's one of the main drivers of that very, very strong policy portfolio return in the 1 year. And over the medium term, it's been the significant performance of, very high inflation in the UK, because the other two have an element of UK inflation built into them. But as I say, the key point for us is that investment managers, we're looking at the absolute returns, or the returns we've generated medium term, which are well in the zone of being sufficient to pay pensions long term as they fall due. So in terms of outlook, we've said falling inflation and interest rates. Is that likely to continue? I would like it to. I think, as I touched on earlier, the impact of Mr. Trump ending up in the White House, I think that has to make you pause for a moment and think, what policies might the United States push forward now when he becomes president in January. And I think the signals are, my personal view is that's likely to put a little bit of pressure on the view that interest rates and inflation continue falling. Until such time that the United States isn't the dominant player in the global economy, you need to pay very close attention to what's happening in Washington and other places. And I think that US policy will put a little bit of pressure on that. I don't think it's going to completely reverse course, but I think you need to keep an eye on, say, inflation and falling interest rates and just be aware of that. And we noted the US election impact. Responsible investment and net zero initiatives. These run very clearly through the LPFA's DNA and ours. We continue to step forward each year with our commitments on both. We develop our thinking, we develop our architecture, let's say. And in terms of net zero, we continue each year to build on the commitments we've made. So we now have a very significant proportion of the portfolio in scope for net zero. I'm not going to mention a number because I don't think we've made it public, but as of yet, we will be talking more publicly about that at some point, updating the next phase of our commitments. But it's now becoming a very significant proportion of the portfolio. And critically, we're doing the difficult stuff, because some of our peers and other pension schemes are talking about having X number of assets in scope, but frankly, they're doing the liquid assets. We're moving through the private markets assets, which are far more challenging to bring into scope. The government focuses on pensions, as you're aware. John mentioned earlier, there's a consultation taking place. Government is very, very focused on pensions, and we're navigating that in consultation with our stakeholders and with government. I think this penultimate point is a key one, that the LPFA is a long-term investor. They're looking over the horizon. We are a long-term investor. We're not looking to make short-term gains or trade short-term opportunities over 1 month, 3 months, 5 months, whatever. We're looking to pay pensions over the long term. And in our mindset, that means multi-generational, that means 10 years, 20 years type horizons, which then gives us the ability to take a long-term perspective and invest in the UK and buy assets that are both accretive to society and accretive to your pension. And part of that ecosystem, so we can invest in the UK and other places and own assets for the long run and not be forced to sell them at inopportune times because we're trying to be overly focused on the short term. So that long-term perspective is so important, and it makes my job a lot more meaningful in many ways, so that myself and our team can look through the short-term fluctuations and think long-term, how do we serve our stakeholders optimally? The LPFA remains in a very strong position financially. Funding levels are very, what's the word I'm looking for? Appropriate, let's say, and strong, and investment performance has been strong in recent years. I don't think John mentioned investment performance, maybe he didn't, but the LPFA, I know because we look at this data carefully, ranks very well versus peer LGPS funds in terms of investment performance in recent times, certainly over 3 and 5 years. So I will end there. I've got some big red flashing zeros. So hopefully I will now make sure I don't forget to introduce the next speaker. I have a big reminder here. So I will now introduce Joe Derbyshire for an update on administration. Thank you. Thank you.
Good morning, everyone. Nice to see you all again. For anybody that hasn't been here in previous years, I'm Jo Derbyshire. I'm the Managing Director of LPFA, and we provide the pensions administration services to the fund, as well as 9 other local government funds, 7 fire authorities, and 1 police force. So what I'm going to run through with you today is just a little bit about our role, where we are operationally, which is different to where we were last year. A little bit about pension increases, because we tend to get quite a lot of questions prior to this session about pension increases. Our focus on member experience heading forwards, because that's why we're here and why we do what we do. A little bit on member comms and some key projects that are going on in the pensions world at large and relevant to the LPFA fund. So we provide a variety of pensions administration services. That includes pension casework. What do we mean by casework? I'll try very hard not to talk in jargon today, because we love a bit of jargon in pensions, don't we? So things like processing retirements, processing transfers into the fund, processing transfers out, all those kinds of things, new joiners, all that kind of thing. We run a circa 30-strong contact centre that handles queries, and I'm going to touch on a little bit of the performance of that contact centre as well today. We provide member engagement and comms. I'm going to cover a little bit on that as well. We have our online member portal, which I hope you're all registered for, and if not, my team are here today to help you do that. And a little bit about what we're doing with employers, because what's really critical in providing a good administration service for fund members is that we do a good job. We educate you all in terms of how you can help us to do a good job, and we work really well with employers. It's that triangle has to come together for excellent administration. So the first graph I'm going to show you is our operational performance for the previous year. So any of you that were here last year will remember that those bars were not all green. So let me just explain what those bars are. So what that is showing you is that for each month of the last 12 months, how many cases we did successfully within the number of days that we have to do them, essentially. And whilst that bar looks really green and beautiful, typically in administration as a whole, and this applies to the whole sector, not just your administrator, we're measuring how well we perform from the point that we receive all information. When that doesn't necessarily translate through to a good member experience, because it could take us a long time to get receipt of all information. So I'm going to cover that a little bit later on, but from the metrics that are standard in this industry, we have recovered from the disruption of moving systems in 2022 and back to a generally really positive picture on the pensions casework. The next graph is a similar graph in terms of months of the year, and this is the performance of our contact centre. And what that's showing you is The big bars in the middle are the number of calls that we get. So you can see that that's not uniform through the year. We get spikes, typically driven by where we send communication out, or if there's a certain time of year where there might be pension increases or annual benefit statements, and some of that that goes on. The average wait time across the year has consistently been under what we target, which is we target a 4-minute wait time. And for the last quarter that's on this graph, the wait time was just 2 minutes, 14 seconds. So I hope that any of you who will recall sort of 18 months ago, there were much longer wait times to get through to our contact centre. That's no longer the case. So I hope that any of you who've tried to get through to our contact centre recently have noticed that wait times have been much shorter than they were just over a year ago. There are some other metrics that we can talk about just in terms of operational performance. So we've got those, the two I've just showed you. Also, complaints were high when we were moving administration systems. It is the most disruptive thing that you can do as an administrator. But we've seen complaints reduced by 50% in the last 12 months. And I'm going to talk to you today a little bit more about what we're doing going forwards in terms of what some of the improvements that we've already introduced and will be introducing and how they will make a difference to the member experience. So the first thing I'm going to cover is what we're doing in terms of automation. So it was very, very painful to move administration systems, but what we've got now is the right foundations to transform the administration service going forwards. So we've started to put in some automation. So these are processes that we can automate and our administrators don't have to touch it. And that means that they've got more time to work on the more complex cases and ultimately start to talk to people and take really proactive action on cases. So we have automated, again, I'll try and de-jargon the jargon, the retirement quotes for deferred members. So a deferred member is someone who has benefits in the scheme, but they're no longer actively working and contributing, but they have these accrued benefits. So what happens is when a deferred member wants to retire, there are two ways that can happen. One is that they would contact our contact centre and say, I'd like to take my benefits now, because there's no employer involved. The other way that they can do it is we run something 3 months prior to their normal retirement date, and that would then send some information out that prompts them to choose whether they'd like to retire on their normal pension date. And what's happened with the automation that we've produced now is that if any of you have deferred benefits and you to ring our contact centre, the person in the contact centre can automate putting your case into the process to deliver a retirement quote. And that can happen almost instantaneously if you have an email address. And on average, what that's done is taken the length of time it takes us from you contacting us to produce a retirement quotation from on average 19 days to 3 days. And there's been some cases where it's been less than 24 hours. And I've seen some cases where we've been able to put pensions into payment in less than 10 days. So this is the kind of stuff that's really going to help. Now we're getting about 70% of those cases through the automation at the minute. The rest exception handle. Why do they exception handle? It's usually to do with the data that we hold. So we're doing quite a lot of work in the background to make sure that the quality of data is really good so that we can get more cases through the automation and really streamline that service. And it probably wouldn't come as a surprise to you that although it's early days and we haven't got too many cases through this yet, the cases that we are getting through the automation show really good levels of member satisfaction because that's what members want, to be paid quickly when the time comes. We have done some other automation around refund quotes when people leave. And also, if you leave and you're not entitled to a refund, how quickly you get the statement of benefits that you've got left in the fund. And some other automation of chasing activity, because there's quite a few cases where we'll be chasing a member for information or we're chasing an employer for information. And we've just, in the last 2 weeks, automated a similar process for the deferred retirements with active retirements. So this is where it's doing a similar thing in terms of very quickly sending out a retirement quote to someone who's got active service. And And you can think of some of this as the building blocks to essentially the end game, is that all members who choose to do so can choose to retire online, and that was where we will ultimately get to. I'll just cover pension increases because I know it's important, maybe it's quite a lot. So for those of you that already have drawn your pension benefits, then increases to your pension are in line with, there's lots of different measures of inflation, but essentially the consumer price index is how your pensions are linked. And for anyone that hasn't taken their pension yet, your pension is essentially revalued on an annual basis. Again, that's in line with the consumer price index. Generally, for those that are retired and over 55, you'll receive the full increase every year, and it's April time when we apply pensions increases. There are cases where you might get a part year revaluation depending on when in the year you retired and so on. Obviously, inflation was low for a long time, but not so much recently. So last year, the pensions increase was high. We were generally kind of going back to the previous sort of September for increases. It will be lower this coming year. So in October 24, the increase from April 25 will be 1.7%. Note that's different to how your state pensions work. State pensions go up by something called a triple lock. That's not how your LPFA pension is increased, so there will be a difference. And the other point I would note is quite often get questions about what happens if you move abroad. The increase to your LPFA pension would carry on if you moved abroad. That's different to potentially what can happen with state benefits. And that depends where you move to in terms of what can happen to those. So I touched on member experience earlier and how some of the automation that we are introducing is really driving an improved member experience. So we've recently started to present back to the team at LPFA a different presentation of how we measure member satisfaction. So I don't expect you to take in everything that's on this slide. It's a bit busy and it's probably a bit small in terms of the numbers. But essentially, the big pie in the middle is how many surveys we send out at the end of a retirement process where someone has retired from active employment. So they're working, they're contributing to their pension and they retire. The large blue bit, the light blue bit, is the amount of people that don't respond to our survey. So the vast majority of people don't respond. The darker blue or black, depending on your colour scheme, is the people that do respond. And then we've got this little slice of the pie on the outside. The green are the people who respond to say that they're satisfied or very satisfied. The sort of neutrally colour in the middle is the people who are neutral. And then the red are the people who say they're satisfied or dissatisfied. So what you can see there is most people don't respond. It's a generally kind of improving picture, but we're not there yet. So we're looking at why are people dissatisfied and what can we do to improve that. And with active employment, active members, it tends to be a combination of when we're notified about when people retire, what we do internally with our processes, and whether a member has an AVC or not. And we're looking into all of those areas to see how we can improve that whole piece to make that retirement experience more satisfying. This next slide is the same presentation, but this is for the members who are not active. So these are the members who've got deferred benefits who retire. And again, what you can see here is most people don't respond. And of those that do, people who retire from a deferred status in the fund are generally happier than those who retire from active status. Now, the only difference really is that for an active person, we have to liaise backwards and forwards with an employer. And if we can make that more efficient, then we will be able to push up the satisfaction for those members that are active. So we're doing a lot of work at the minute in terms of understanding every part of this process end to end and how we can improve it. The next slide just covers our contact centre. There's 2 slides here, so if you ever call our contact centre, you will have the option to stay on and give us feedback. And we ask you essentially 2 questions. Whether you're happy with our overall service, and whether you were happy with the person you spoke to. And I'll summarise these two quickly. So this first one is the overall service, and the second one is the person you spoke to. So the takeaway from that is that generally people are quite happy with the person they spoke to, and they're generally happier but less happy with the overall service. And that tends to be because you've probably spoken to someone who's really nice, but if they can't satisfy the query that you're asking them in terms of why there may be delays to payments, then they're not going to be quite as happy. Member comms, so we have a dedicated member engagement team at LPFA, LPPA even, too many L's. We've got some videos on the website, lots of videos on the website. We've also, it's one of our forays into the first uses of artificial intelligence here. So there are, there's bits of AI you can use where you can give it a script and essentially an avatar who looks like a human will talk. And we found that quite useful because there aren't many volunteers to go on camera and talk about things at LPPA. So being able to give it to someone that looks like a human and can do it really professionally helps. So we've got some of those. We send newsletters, emails, we do member training, and we also have member research panels. If any of you are interested in joining one of the member panels, do speak to my team outside and they'd be able to sign you up to give us some feedback on things. So we send statutory communications that some of you will get every year, annual benefit statements, things like that, and put pay slips and things like that into our online portal. There's lots and lots of information on our website, so please do go and have a look if you've got any questions, and you can also contact us via the website, or obviously you can call the help desk. We did send a newsletter out earlier this year. Just to give you an example, we sent 25,000 emails to LPFA members. We got about a 60% open rate, which is quite high for emails. And that drove about 2,500 members to our website. On that slide are the top topics that people are interested in. Pension increases, hence why I've spoken about a little bit about them today. And questions about annual benefit statements, how to nominate a beneficiary, really important, so that we can speed up that process, and other bits and pieces. Pension Point, I talk about this every year, so I know I bore you to death with this. But that is our online portal. It's secure. It has two-factor authentication for any of you that like that kind of IT jargon. It just means that you will get a separate code that will be sent to you to be able to log in to try and make sure that it's secure. Lots of things you can do in there. Run your own pension estimates if you've not retired yet. Documents will go in there. It's a really good space. So currently about 34% of LPFA members are registered. That's probably about in line with what we would see in the industry at large for pension funds and how many members are registered. But please do go on, and like I say, if you've got any trouble logging in at all, do speak to my team outside. And I'm just going to finish with a couple of projects that are going on in the pensions world at large. So you may have heard about the pension dashboard. This is a government initiative to allow us all to keep track of lost pensions. Many of us move jobs and have different pensions throughout our lifetime. So we, as your administrator, are going to be plugging into the central dashboard ecosystem. So we'll be sending lots and lots of data into this system. And the deadline that we've been given to do that for public sector schemes is 31st of October next year. So that data will go in. What will you see as consumers? You'll be able to log on to the dashboard, and confusingly there will be multiple dashboards, but you will log in, you'll be able to put things in like your name, your national insurance number, your date of birth, and it's going to return all the pensions that you've participated in through your lifetime and give you contact details to go and investigate those further. So that's going to be, now, the date that we plug the data in is not the date that the dashboards go live. We don't know when that is yet. That's going to be, it's called the dashboard available point. And all we know at this stage is we're going to be given about 6 months notice before it goes live. So I would expect probably sometime in 2026. The challenge for us as your administrator is to understand what changes that's going to bring for us, because we're going to get new kinds of queries into LPPA that we don't get currently. And all it will take is for Martin Lewis to be on BBC Breakfast, and the contact centre will light up like a Christmas tree. So those are the kinds of challenges that we're looking at around pension dashboard. We are doing an ongoing piece of work around something called McLeod remedy. So some of you may know this already, but McLeod was a judge who successfully appealed that changes to public sector pensions that were undertaken in 2014 and 15 were age discriminatory. So essentially people who were closer to retirement were allowed to stay in the legacy schemes longer than younger people. So we have a huge task to effectively correct that and provide redress to people. So where are we for LPFA members? At the moment, anyone who's retiring today, who's got service in that qualifying remedy period, our systems will essentially run two calculations and say, were you better off having moved to the care scheme, which is the newer scheme, when you did, or would it have been better if you stayed in the legacy scheme? And it will essentially do a best of both. And it will do that real time, and it will provide you with the best of, so that you don't lose out. We've then got a huge exercise to do, to go backwards for all the people who are already drawing benefits or have transferred out or have pension sharing orders and all of these things, to correct all of those as well. So thousands and thousands of cases that we'll need to revisit when we get the software to do that early next year. Just to set your expectations though, we've run about 700 cases through this best of both so far. It provides a benefit to less than 4% of LGPS members, and the average uplift in benefits is about £250 per annum. So don't go buying your super yachts quite yet. Next year, for any of you that do have service in that remedy period, you will get your annual benefit statement, if you get one, will include that underpin. It will show you kind of that best of both calculation. So that's coming next year, which will be a bit of a change for annual benefit statements. And then finally, it would be remiss of me to let you go without just saying, cyber is the largest risk we face as your administrator with the data that we hold. We have certification, we have Cyber Essentials Plus, we have ISO 27001. The portal has, like I say, authentication to keep it safe. But please do be aware. Scams just get more and more sophisticated all the time. So just be careful with data, but that's everything we do to try and keep your data safe. But as someone said to me, even the Pentagon gets hacked. So all our organisations really come from the standpoint of it's not necessarily if, it's when. Thank you, and I'm going to let you escape for a minute to have a coffee break. Please be back here by 12:25 when Paul Hewitt is going to give an update on responsible investment. But please take time to enjoy the refreshments, and there is a stand outside with my team if you've got questions about your own individual circumstances. There's also a stand that can give you some tax advice as well. So thank you very much for listening.
Thank you. Good afternoon, everybody. I hope you've had a good coffee break. I was slightly concerned that evidently somebody somewhere took the decision that you would need a hit of caffeine before listening to me for 15 minutes. So I do hope that this is suitably engaging and accessible for you. My name's Paul Hewitt. I'm here to talk to you today about the responsible investment work that we do here at the LPFA. And those of you who were here last year will have heard me talk about the development of our RI policy. So this year we're going to be moving that message forward a little bit and talking through how we're working with our RI policy and our climate change policy. We'll be looking at how we've been developing and pushing forward our net zero agenda work, some of the groundbreaking transparency initiatives that we've been undertaking, and also to talk to you a little bit about the vote monitoring work that we've been doing as a part of the getting a deeper understanding of our fund managers and their work for us. So that first point about working with our policy. You may remember from last year I talked about what the themes of our RI policy are and the objectives related to them. So I just thought it would be useful just to give you a very quick check back over those. So we've got 6 themes: renewable energy and distribution, pollution and the circular economy, which are both environmental related themes. Then we have 2 socially related themes: fair pay and diversity, equity and inclusion. And then 2 more governance related themes: accountability and oversight, which is something that's important to us as a fund and the way that we operate, as much as it is in relation to how the companies and investments that we're exposed to also work. And then we also have cybersecurity and responsible technology developments, as well as our 6th, and by no means final, least theme. So, what are some of the things that we've been doing to work with our policies this year? Well, in relation to the RI policy, one of the questions is, well, what do we want to do? How do we evidence what it is that we're doing towards reaching those objectives that we've identified? So the obvious answer to that is, well, we should be using some metrics. So we've been doing a lot of work with LPPI, our managers, to identify what metrics we might want to think about making use of. It's a much simpler sounding question than it actually is in practice, because we're invested across such a diverse portfolio, particularly of companies, in those listed companies that we're invested in, that metrics that are relevant in the context of our RI policy for one company may be really not that relevant for another company in a completely different sector. So to take, for example, a mining company that uses a lot of water and a lot of natural resources in the things that they do, they're going to have a very different environmental footprint to a life insurance company that's entirely office-based. So when we look at metrics at the whole portfolio level, we're thinking about, well, what are the things that at that portfolio level, what are the metrics that are relevant to the largest number of companies in the most meaningful way that we can then use to signal how we're getting towards that objective? So that's a really quite complex set of questions. So we're still in the process of landing on the full set of metrics that we're going to be using. But hopefully that's given you a flavour of a lot of the questions that we've been grappling with. Secondly, we've been doing a lot of work in terms of expanding the scope of our policies, and particularly in relation to our net zero work, and I'll be talking through a lot more about that in a short while. And then we've also been developing monitoring and reporting processes. So one of the greatest advantages now of having our RI policy that sets clearly what our objectives are is it gives a frame of reference for our investment managers, LPPI, when they're reporting back to us about the work that they're doing and the significance of the progress that they've been making to enable our investment committee to understand the relevance between what the managers are doing in the context of our policy. And one of the clearest pieces that we've developed over this year has been vote monitoring, which again, we'll hear more about later on. So that's what we've been doing internally with our policy, but we've also been doing a lot of work externally with our policy as well, publicising them not just on our website, but also attracting industry press coverage. And we even got nominated for an award for our climate change policy, which was shortlisted, particularly because of the references that we made to biodiversity in the context of climate change there. So I mentioned that I would dive into a little bit more detail in the context of our net zero work to show you what we're doing to expand the scope of our policy. So we announced a net zero commitment in 2021. We published an investor climate action plan in 2022, which contained the first set of targets that we had set for some of our fund. And when I say some of, it was the largest single asset class set, the listed companies, which is about half of the fund that we are invested in. And we set a number of targets in relation to those companies around emissions intensity, implied temperature rise, which is a really interesting concept. I'll briefly touch on that in a moment in more detail. And then the degree of alignment with the Paris Agreement. So the Paris Agreement is that global agreement that governments agreed in 2015 at the COP21, I think it was, to commit towards getting the world to limit our emissions so that climate change didn't get us above 1.5 degrees temperature rise above pre-industrial levels. So that alignment measure is what sits behind that implied temperature rise, where we're looking at our portfolio and saying, if the world was the same as our portfolio, would the world warm more than 1.5 degrees, or more than 2 degrees, I should say, or not? And then the engagement measure is the proportion of companies in our portfolio who are reasonably high emitters that we are talking to encourage them to make the necessary commitments to get them aligned as well. So a lot of activities and metrics there that sit behind those targets we set for the listed equity and also the corporate fixed income, so bonds, lending book that we have within the fund. We also set in 2023 targets in relation to directly held real estate, so buildings that we're invested in relation to emissions, and also again in relation to alignment and engagement. So we've been making good progress in relation to those measures and metrics. We are either ahead of target in all of them, or where we're not ahead of target, it's because in the intervening period, we've been able to access better information about the portfolio. So although the numbers look like they may have gone in the wrong direction, actually, the numbers we have today are better quality than the numbers that we had yesterday. And that gives us better information with which we can then continue to work to move below the target rate that we have. So in terms of alignment and engagement, you can see there with the listed equity book, we are ahead of schedule at the moment. With real estate, again, we have that data quality issue where better data has revealed that we've got a little bit more work to do than we originally were able to calculate for at the beginning. But again, that portfolio coverage measure tells us that we are in touch with literally everything in the portfolio in order to make that change effective. So that's where we've got to with the targets we'd previously set. But we're also in the process of setting targets in some new asset classes and new areas. So during this year, just gone, we've successfully set new targets for our indirectly held real estate book. I was hoping not to have to get too technical, but I'm going to have to here. So we have directly held real estate assets. So those are assets that are held and managed directly by LPPI. But there are also other buildings that we are invested in through LPPI, who in their turn invest through other third-party real estate fund managers. So those assets there that are through indirect parties, they're the indirectly held real estate assets. So we've managed to set climate change, net zero related targets for assets held by those managers external to LPPI as well. We've also expanded into the infrastructure asset class as well. So those rail, ports, schools, and so on, infrastructure type assets, also the renewable energy assets that we have within the fund, so the wind farms, the communal battery storage assets. We've managed to set targets for all of that asset class as well. And we're in the process right now of considering what proportion of our overall fund we're going to commit to having invested in climate solutions. So we've been undertaking a tremendous amount of work this year, not forgetting that we still have more work to do beyond this in relation to those private equity assets that we have within the fund, and also some of those fixed income instruments that are that are non-corporate, so where we hold gilts and other types of public debt. I mentioned we've been doing a lot of work in increasing our transparency as well. So all of our policies you can see up on our website, our RI policy and our climate change policy, and you may well see some climate voting principles appear there in the foreseeable future as well. We have our Net Zero Hub that you can go on and you can see all of the progress that I've been reporting to you just now in relation to our net zero goals, and have a peruse through there and see how we're getting on. That's updated every 6 months with a fresh set of data so that you can evaluate and see our net zero progress reporting. We also have our transparency dashboard, which is, in my view, a really tremendous piece of work where anybody, not just our members, but anybody that's got access to the internet can go and see the entire list of companies that we're invested in our listed equity portfolio. Not many funds do that, certainly not in its entirety. But even beyond that, we've also published this year our Investing in the UK report. And that was looking at all of the physical assets that we're invested in within the UK, so buildings and infrastructure assets that I was talking about earlier on. So you can go onto the website there and you can see exactly what we're invested in and where those investments are. And that's a tremendously innovative piece of work that has attracted a lot of positive attention through the industry. Lastly, stewardship. So stewardship is a technical sounding term for essentially the activities that we do to talk to the investments that we have in the portfolio. So if you remember, I mentioned listed equity represents roughly about half of our fund. All of the companies in our listed equity portfolio have AGMs each year, and those AGMs bring with them voting rights that come with the shares that we hold. And the way that those voting rights are made use of is an important part of how we and our managers communicate to those companies about the preferences we have. So because we have such a high profile commitment in relation to climate risk, we have set up some vote monitoring activity so that we can evaluate the use of voting rights that are made by LPPI against the commitments and priorities that we've identified in relation to climate risk. So we've appointed a specialist research provider to provide us with alerts about all of the potential concerns at each and every meeting that that LPPI have a right to vote at on our behalf. They provide us with those alerts, and they then compare those alerts against the reporting that LPPI provide them with about how they've actually made use of those votes. And then we get an exception report showing us where there are any differences between the output of our policy and the actual voting that's undertaken by LPPI. What we then do is we can go to LPPI and say, okay, here are the differences. We'd like to understand what sits behind those differences. What's the decision-making process that led you to do that when our policy says this? And that conversation allows us to unearth some really informative and helpful insight into the way that voting rights are made use of in the context of those ongoing discussions that managers have with companies in the portfolio. And very often, because voting against the re-election of a director or the approval of the remuneration report or the approval of the report and accounts is actually quite a high profile and importantly public act that is therefore quite high up the escalation list of an engagement process. So it enables us to understand importantly how those voting rights are being made use of. It also enables us to flag to LPPI that we're aware of what those climate risk points are. So it improves our relationship and understanding of what is being done across the portfolio in terms of engagement. So that's just one example of how we've been working in terms of reporting and oversight, which is consistent with our accountability and oversight piece in our own RI policy, so we can show we're walking our own talk as well in that regard. So key takeaways for you, if you forget everything else I've said to you today, that we have a new RI policy, we're working with it, we're expanding the scope of it, particularly through our net zero work. We've got a fantastic range of transparency initiatives that enable you to know a tremendous amount about what we're invested in, and to understand that we are also working collaboratively with our managers to understand the stewardship work and how they are improving the work that they're doing to improve the returns in terms of responsible investments impact in the portfolio. So thank you very much for listening. Hopefully the coffee did its job. And so we will be moving on now to take some questions from you and also from our online audience. And we'll be responding to those that have been also submitted to us in advance today. So please just bear with us whilst the rest of my friends and colleagues come back onto the stage, and we'll begin that shortly.
Welcome back. It's really good to see you again. I'd like to introduce Lana Watson, who you haven't met before, is our Funding and Investment Director, and is here to answer some of the questions I hope we're going to ask. We've got about 30 minutes for questions, so hopefully we're going to have plenty of time. I'll come to the audience in just a second. We've also had a number of questions, both in advance and from people online during the course of today. So hopefully we'll get a chance to do that. I would just make a couple of general observations. As I mentioned earlier, I'm afraid we can't address any personal pension questions that any of you may have, but as I hope you all found during the coffee break, both LPPA are outside together with a desk from TaxAid if you have any particular tax-related questions. And secondly, as you would expect, we do get quite a lot of questions which are broadly the same, so what we've tried to do is group them together. So if you asked a question and what I read out isn't exactly the words you used, it's because we've amalgamated it with a few other questions which were broadly the same thing. So with that, can I start with a question from the audience? We have colleagues who have roving mics, so can I ask you to raise your hands, and when I call upon you, somebody will come to you with a mic. Gentleman there, please. Is that working? That's better. No, I'm sorry, it's still not working.
Bushman has a mic there.
We'll try a second mic. We could put people on the moon and we can't get a microphone to work, but never mind.
Hi again.
That's better.
So, we all know that the world is inflamed, the conflicts and the wars around the world, like the Middle East and the Ukraine-Russian war, and the great unpredictability, coming from the US, like Trump-like impulses, right? So how do you actually take these risks in your risk assessments for the future, and how do you envisage actually these risks in order to, some sort of predictions for the future?
So Richard, how do you take the sort of global socio-political and economic issues into account, Ukraine and things like that?
Sure. So absolutely, they're critical things that we think about, and there are various different ways to frame those issues. What I'd say is that we've lived through an era where the world was pretty calm for a long period. Everyone played nice, and I think you could just invest globally, and you didn't have to focus on many of these things too much. I think that era is now behind us. So you do need to absolutely, to your point, accept and embrace that some of these risks are present. There are different ways to address that. Nobody has a crystal ball. And generally, when you think you have a big view and you want to invest on the back of it, you tend to find that you do it at the wrong time, or your behavioural biases and emotions quite often mislead you. So you have to be systematic and disciplined. What I would say is one thing that we have been doing for several years now within LPPI is to use the term wargaming type techniques, scenario planning approaches to some of these geopolitical events, to look at them and say, if this evolves in this scenario, what might happen? How might we evolve the portfolio as a way of thinking what exposures we might have and how our risks might evolve and what actions we might take? And we've done that twice now in the last few years to really tease out some of these very, very challenging issues to try and think them through. I'd layer on top of that, I think where we live in a world today now is where you have to look quite carefully on a global basis, almost on an asset grouping and on a regional basis, and just be mindful of financial risks to those assets. So I'm being very clear, financial risk to what might happen. So it means that certain asset groups that were would have quite happily invested in 5 to 10 years ago now feel more challenging or potentially uninvestable based on geopolitical concerns from a financial risk perspective.
Thank you. Can I turn to a question that's been asked in advance? And Lana, if I can bring you in straight away, which is it possible for the LPFA to finance independent pensions advice for members?
Yeah, thanks. So I think we have looked at things like this in the past, and I think really it's difficult for a fund to do this at a fund level. Where it can become valuable is for the employers to think about providing this, potentially as part of their benefit package or financial well-being program that they've implemented within their organization. So I think that's the primary place where things like financial advice, where it's financed, can come into play. Clearly, we do have areas where if anyone asks, we can point them in the direction. Unbiased.co.uk is a great place to give you assurance that the financial advisors they put on there are registered and appropriate. And then you can look for someone in your specific area who has the expertise that you're looking for support with.
Thank you. Another question from the audience, if I may. Gentleman there, please. Sorry, I'm making you run the entire length of the thing. That was really unkind. I'm sorry.
Thank you. Thank you for the presentations. I thought they were good, and I've got really sort of comment questions. I was unaware that you had an annual report, and it's online. I have difficulty reading annual reports online. I do a lot of work on computers. So is that available on hard copy? And the second point is that I was given this document as we came in, and there's a blank page. You talk about investments, so adding 3 or 4 pages on your investments, sort of summarising them, and so some of your slides I think would be a useful addition.
Thank you. We'll certainly think about that. Annual report in hard copy. I think we do have hard copies available. Are there some outside?
I'm not sure if we have any available, but we can take your name after and certainly post you a copy. And anyone else, if you either email us or call us, we can certainly post copies to anyone who needs them.
I would just add that in the interest of responsible investment, these things are very long, very complicated, and we do try very hard not to chop down a couple of forests in producing copies of this because they are very long and complicated, but they are available online. And I hope that nobody is having significant difficulties accessing this online. If anybody does, please do drop us a line and let us know, and we'll try and look at it, because that's not the way it's supposed to be. It should be very easy for people to get to. All LGPS funds produce an annual report. We've done it for many years. There is a deadline. I have to say a number of funds don't make that deadline. I'm very pleased to say that we did. We published last Friday. Perhaps I can just take another question from the online. Joe, a question that came in about the pensions dashboard. Is the pensions dashboard secure?
The pensions dashboard program, I've been putting a lot of effort into data security in a few different ways. So one is making sure that that ecosystem that I referenced is safe as possible. But I guess just to reassure you, they're not creating some great big new central database that can get hacked of data. It's more sophisticated than that. I think the other thing that they're doing is there's been a lot of thought given to how they can make the dashboard not open to fraudsters. So for example, if you are supplying a couple of bits, but maybe you don't know your national insurance number, is the dashboard going to come back and actually give a fraudster who's got some of your information, even more of your information? So they've been considering those angles as well. I guess is it safe? I guess that comes back to is the Pentagon safe? It's as safe as it can possibly be, and lots of thought is going into it.
Thank you. Another question from the audience. Lady at the front down here, please.
Hi, yeah, your presentation was very helpful. It's answered quite a few questions. But to follow on from 2 of the comments some of the people made, one of them is, I don't find your portal very user-friendly or very informative. I have a previous pension from previous employers, which is on Pension B now, and I find their app really, really helpful, really transparent, really user-friendly. So do you have any intention to develop an app which would just make things like your presentation really easy to see? That's one of the questions. And then secondly, the gentleman was talking about the wars and conflicts going on in the world. You pointed out that we're not ethical investors. We invest in, it's about money, it's about risk. It's that, because one could argue a lot of money is made during the war. So do you invest in, say, arms dealers or people or organisations that are making a lot of money from the ongoing conflicts?
Just hit the first point, Joe, and then
Yeah.
perhaps Richard, I'll come to you, and Paul, ask you to pick up on that as well. So go.
Yeah, so just for clarity, obviously the portal that we're giving you as LPPA, as LPFA's administrator, is only going to show you your LPFA pension. The dashboard that I talked about at the end of my presentation is a government initiative that will show you all the pensions that you have. It's still early days for us, given that we moved administration systems in 2022, so we do absolutely have plans to develop the portal to be more user-friendly, to have more functionality, things that we are looking ahead in the next 2 years. So retire online I touched on, so the ability for people to retire online, also the ability for you to track your case. You know, you can track a parcel on Amazon these days. You should be able to track where your pension case is up to. So that's probably a couple of examples of where the functionality will improve. And in terms of an app, I was asked this question outside actually, so it's really interesting. Apps are brilliant if you use them frequently. I'm sure I and many others use your banking app very frequently. What happens with engagement in pensions is it's dependent on where you are in your lifestyle. They're also great for pushing information, so push notifications that some of you might have set up on some of your apps are really good ways to communicate. The flip side is apps are incredibly expensive to maintain. Every time a new operating system comes out on a different type of phone, whether that's Android or Apple, you've got costs associated with that. So what we're doing is considering whether or not, you know, an app is the right way to go. What you'll find in sectors where people don't use apps that frequently is there's more of a push to making websites more mobile compatible rather than actually introducing an app for just economic reasons, but it's not off the table. So at the risk of sitting on the fence, maybe.
Richard, can I come to you first on the...
Yeah, so to be candid, it's a very challenging topic to talk about, especially on a stage. But what I'd say is, you know, from my personal perspective as a human of the world, I absolutely empathise with what you're talking about and some of the challenges around armed conflict. It's a very, you know, challenging subject. If I step into my professional world, let's say, put my professional hat on, as you noted, first of all, the core purpose of what we're here for is to pay pensions as they fall due. But if you drop them further into that, the defence sector has been debated for many years, and there is two sides to that debate. We have policies in place. We have a responsible, an ESG set of policies within that. We have policies on non-conventional weapons, so nuclear, cluster munitions and the like. So those are excluded, non-conventional weapons are excluded, so cluster munitions and chemical and biological, and then nuclear proliferation is the treaty countries. So there's a set of framing around that. But fundamentally, the challenges that we're looking at, really these are issues for the British government, for national governments, rather than people such as us. However, as I say, there are some holdings in defence companies, candidly, within the portfolio, and they're all in line with that policy. However, for every, if you look at it from the one lens of, you know, which lens you take it from, because there's obviously a European security challenge that we face, and that can be argued from both perspectives. So it's a very nuanced argument. But yes, the short answer is there are some holdings, but they're compliant with all our policies, which are then aligned with British government policy and similar.
Paul, anything you'd like to add?
Yeah, I think Richard has covered a lot of the detail of it. I think all of the detailed thinking that our managers undertake on our behalf is within the framework of our own sort of RI policy preferences, and our RI beliefs start really with the premise that environmental, social and governance issues are material to our holdings. And what that means in the context of this question is that, for example, there's a lot of overlap between companies that are involved in defence technology development and other civilian strategically significant activities like aerospace, like telecommunications. So it's not necessarily always as cut and dried as one might expect. And of course, that's getting well beyond the detail of what is an overarching policy framework within which our managers then carry out the very important investment work.
Thank you. I think I'll take a question next from the pad, which is Rachel Reeves is talking about mega funds. What's the risk to LPFA's autonomy, your administration service, and my rights as a pensioner? I tried to cover some of this during my remarks earlier. The short answer to this is, based on the proposals at the moment, it shouldn't affect it at all. And I do emphasise the proposals at the moment. I mean, what the government is doing is they're setting out some minimum standards they expect the investment pools, which I talked about, LPPI are doing. They are setting out some minimum standards about the way in which pension funds should be governed. And they're setting out some requirements, they're setting out some encouragements. At this stage, it's only encouragement to get people to think about investing more locally. But the crucial point here is their encouragements. As of today, the government has not mandated anything about the way in which we should invest. And there is a strong pushback from amongst both the investment and the pension community to say, we don't want to be told how to invest. We think that is counterproductive and unhelpful. But crucially, as I tried to demonstrate earlier, I think all the evidence is that when you look at the way in which funds invest, certainly if you look at the way in which we invest, and LPPI invests on our behalf, we are already doing the things that the government wants us to do because they make economic sense. So I think I mentioned already 13% of our assets are invested in UK infrastructure and real estate. So we don't need the government to tell us what to do. It makes economic sense for us to do it, and we've been doing it for a while. And I think the government are hearing that message. And the only observation I would make about these government proposals is they are consulting very, very widely. I think, Lana, you've probably been on about 10 phone calls and meetings with the government so far, and they're trying to do that across 86 funds and 8 pools and everybody else. So, you know, I can't tell you how well they're listening, but they're certainly asking the questions. Perhaps I can take another question from the audience, please. I've lost where the mic is, so I'm trying to be nice. Can we ask this gentleman at the back up there?
Yes, I saw on the map of where you invested, you'd invested in some hospitals, which I like the look, the sound of that. How would that investment sort of work in detail? So would it be something like you own the buildings and charge the hospital trust a rent, or do you provide sort of services or cleaning services? I was just wondering what detail you could tell me about how that investment in hospital trusts, I assume, how it went.
I suspect I'm going to lose a friend when I do this, but Richard, how would you like to?
It's more the former, not the latter. So it's owning the architecture and the infrastructure of the asset rather than the services that sit within it is the short answer. So it's the owning the, as you say, the asset, not the operating business. So that filters through multiple elements of the portfolio. But certainly in this case of hospitals, we're not operating hospitals. We're owning fixed assets as part of the various parts of the portfolio. Yeah.
Yes.
Exactly. It's the operator, which in many cases is the NHS or similar.
And if you think about it, that is actually what the country needs. It's the capital to invest in these buildings. The local authorities or the government have the obligation already to run the hospitals, so they don't need us to provide that service. What they need is capital to build the buildings in the first place, or to fix the roads, or whatever it is. And that's where the infrastructure investments and the pension funds can make a real difference. Another question from the audience. Down here, please, lady.
Yeah, hi, thank you. I'm Lois Robinson. My fund comes from local government, and so I've written quite a few questions. I think some of them I'll send through to you to answer independently, but I think my immediate concern is with so many local authorities claiming financial difficulty or bankruptcy, what happens if they can't meet their pension obligations? How are the people that get their pensions from them, how will they be collecting their pensions? That's one question. And then with, obviously, we're a global world now, and with the rise in BRICS, which is Brazil, Russia, India, China, and South Africa, and the additional partners that they're bringing on board, which is a real concern to America. How are we taking that on board in terms of moving forward, and how much investment are we doing in developing countries such as the African continent and India, etc.? What percentage of our investments are there? It'd be silly to ignore those as continents as potentially they're due to rise. So that's basically my question.
So let's take each of those in turn. The first one, the question about what happens if a local authority goes bust. I would just observe that actually the government would never really allow a local authority to go bust, but I do understand the point you're making, Lana. Perhaps I could come to you. How would, if a local authority stopped paying, or indeed some of our admitted bodies stopped paying, what happens to the liabilities and pensions?
Yeah, so I think you're right that there are some local authorities that are struggling, and obviously some of them are, issuing notices and requiring extra funding. I think pension contributions fall into the category of required of funding that they need to continue. So there's certain expenses and things that they need to continue even if they go into the Section 114 notice. So that is important because those do continue. But in most cases, there's government guarantee as well. That means that should it get to the point where they can't even afford to pay those contributions outside of anything else, there is a government guarantee for scheduled bodies that require the government to be the final backstop for any contributions or any pensions that are due.
And it's probably worth just adding that, of course, we're only talking about liabilities for the future, if you see what I mean. The fund is there to meet the liabilities of pensions that have accrued to date. The challenge would be over whether we would be able to fund liabilities going forward. And as Lana says, there are significant guarantees around that. In relation to the second point, Richard.
So what I'd say is, if you think about the core purpose of the pension scheme, is to pay pensions as they fall due in sterling that are linked to UK inflation. So everything rolls back from that in terms of building an investment portfolio, and we try and do that in an efficient and affordable way and manage within a risk framework. So the portfolio presently is skewed towards the UK, partly because of linkage to UK inflation, partly for the sustainability beliefs and what our clients are asking us to do. There is a material exposure to global equities, but the bulk of those are, well, now, even more so than ever before, US-based, but those businesses have exposure globally. So you can look at many large businesses. I think John made the point, actually. I think you mentioned BP. You said BP is listed in Britain, headquartered in Britain, but it's really a global business. Those assets will be in, many of the assets of BP will be in the nations you mentioned. So there's certainly, the portfolio has exposure to those assets. That's what we're trying to do, to those regions, I should say, sorry. I think part of the point I think you were driving at, though, is the subtler point of, in a world that is dominated by the US dollar, and the US, I won't use the words, I always get hegemony, I always get it wrong, I can't pronounce it correctly, but a world dominated by the United States, how that evolves, and I think that's something we think carefully about. I don't think that changes on a 1, 2, 3 year horizon, but on a 10, 20 year horizon, absolutely, you've got to be thinking that way. But currently, the portfolio is skewed more towards developed markets in terms of where the assets are registered, but in terms of exposure, in terms of revenues and other things, it is a genuinely global portfolio.
I think we've got time for just one more question from the audience, if I may. Gentleman there.
Thank you for the introduction, the presentations. Just going back to your slogan, it says, your pensions, our world. How much is our pensions in your world, and how much actually is our pensions in our world? So this is, on those lines, basically, I can see that there's about, you talk about 8% returns on the investments. Out of this 8%, 264 million has been invested in, basically paid as pensions, and basically it leaves, that's about 3% of the return, 1% on the costs. So there's about 4% of the return is being actually used, and other 4% seem to be reinvested. So is this for just the rainy days, or is this something that actually pensioners can benefit from directly and more kind of imminently?
I'm trying to understand the question. I think you were trying to break down the 7 or 8% return into its
Okay,
subsequent...
well, basically, the first question, part of the question is how much is actually our pensions, our world, because rather than your world, put it this way. And out of this 8% of the annual revenues from 8 billion of capital investment, I think only 4% have been divided between the costs of the management and the pensions being paid, and approximately the other 4% is being reinvested, as I understand, or I don't know what happens to the other 4%. And can pensioners benefit from this additional 4% more imminently?
So I think I've answered the question now. So just stepping back, there's 8 billion of capital in the fund. That is to pay the pensions in the future. The pensions that you receive are fixed by central government. So the pension you're going to get is the same whatever happens to the investment performance. It doesn't impact your outcomes. The employers in the scheme, it impacts their outcomes, and people contributing to the scheme today, yes, it impacts that, but in terms of the outcome, in terms of paying to pensions, it's a defined benefit pension scheme. In terms of the breakdown of the returns, I think what you're getting at is how some of it is taken in fees of managing the scheme, absolutely, and there is some that is used to pay pensions today. So, and then if you break out the bit that's used to pay pension today, it might be worth Lana, but you're more familiar with the numbers. I don't want to throw you under the bus, but I'll give an answer, and you might just want to add to what I say. I'll give a simple answer, and you're probably more in the weeds than I am. But a proportion of you've got capital coming in from employers and contributions. Some of that is used to pay pensions today, and the portfolio also generates income, which may be used to pay pensions today. But the amount of cash flow you need to pay pensions in any given year fluctuates depending on the membership and the current contributions and the income generated. So it isn't a fixed amount, and that evolves through time as the scheme matures. And Lana and myself and others will look very carefully at what that cash flow profile is going to look like over the next 20, 30 years. So it's a dynamic evolution, but there is nothing that's coming to us as the managers of the scheme. It is all the scheme's assets, and any income that is generated either goes to paying fees for the management, paying pensions today, or being reinvested in the fund to pay future pensions.
Yeah, I think that's right. I think effectively it breaks down to there's 2 ways that we can accumulate money to pay pensions. It's either employer contributions or the investment returns that we get. And so it's a combination of those 2 things. And that's where you end up either in deficit, you need more employer contributions, you need more returns, or you end up in surplus where maybe the employer returns can be reduced a bit and you can rely more on the investment returns. And the breakdown between the actual amounts that are used to pay pensions between the employer contributions or some of the investment and the income that comes from that varies and depends on year to year. But it's all thought about in the round. So we don't actually sort of think about, well, we need this little bit over here to pay these pensions over here. It's all thought about in the round and looking forward to what we're going to need.
I suppose the only other point I'd make, just in terms of costs and whether we're cost effective and cost efficient, we were the first people to get into investment pooling before it was actually mandated by the government. We have gone further and faster with pooling than just about anybody else in the UK. To put that in context, LPPI makes up something like 8 or 9% of the total assets of the LGPS in the UK. And so far, if you take the total savings that have been realised by pooling across the UK, we've realised about 25% of those savings. We've saved about £100 million so far from the way in which we pool. So we are constantly looking to try and see if we can find ways of saving money. The investment management fees are by far and away the largest cost that we incur, as is true for any pension fund, and we've gone further than anybody else in actually achieving those savings. Thank you very much indeed. I'm afraid we have got the end. I'm now standing between you and lunch, and I don't want to do that anymore. But it has been a great pleasure for us to see you today. We hope that you found this valuable. I repeat what I said at the beginning. If you take nothing else away from this other than your pension is secure, then that will have been time well spent. I hope you enjoy lunch. We will be around over lunch if anybody would like to ask us some more questions. Thank you for coming today.